In the world of finance, it's so easy to get caught up in the daily price swings and the flashy headlines. But today, we're going to look at something way more powerful, a hidden undercurrent. We're talking about following the actual flow of money, and we're going to do it by looking at one key indicator, ETF inflows.
We all see prices go up, we see them go down, but what's really driving all that? Is it just random noise and a bunch of news headlines? Or is there a deeper, more powerful force that we can actually track?
Well, the answer is a huge yes. The real story, the one that matters, isn't always in the crazy zigzags of a price chart. It's about understanding where the actual cash is going. And honestly, one of the best ways to see that in real time is by tracking ETF inflows.
So, let's pull back the curtain a little bit. We're about to dive into an indicator that can show us what the big institutions are doing, what the general feeling of the market is, and even spot the big trends that are shaping everything.
And look, this isn't some minor detail for finance nerds. The movement of money into and out of these things called exchange-traded funds, ETFs, has become this absolutely dominant force. It influences everything from the S&P 500's direction to the price of Bitcoin.
And here's why this is so cool. When we track these money flows, we get this direct window into the market's brain. We can see how investors are feeling, we can see where the huge pension funds are placing their bets, get a read on market health, and sometimes we can spot major trends before they hit the mainstream.
Okay, so to really get this, we got to look under the hood. What exactly is an ETF inflow? And how does it work? How does it actually show us what the market wants?
At its absolute core, it's super simple. An ETF inflow is just new money being put into a fund. That's it. It's a direct measurement of cash moving from the sidelines into a specific part of the market.
And it really is a two-sided coin. You have inflows, which means fresh money is coming in, signaling confidence and growing demand. And then you have outflows. That's money being pulled out, which can suggest that demand is shrinking or investors are getting a bit nervous. Now, here's the behind-the-scenes magic, and this part is so important. This isn't just numbers on a spreadsheet. When tons of people start buying an ETF, some specialized firms, they're called authorized participants, literally step in and create brand new shares. But to do that, the fund itself has to go out and buy the actual stuff inside it, whether that's Apple stock, government bonds, or even physical Bitcoin. And that right there is the key. That whole creation process makes a direct physical link between you buying an ETF share and real buying pressure in the actual market. It's pretty straightforward. Money flows in and assets have to get bought. Period.
To make this totally crystal clear, let's look at a perfect, very recent example where this whole inflow thing has been front-page news. The spot Bitcoin ETFs.
Just look at this chart. See those long red bars? Each one represents a streak of days where more money came in than went out. These aren't just random little spikes. This is sustained, committed demand, often from very large, very serious institutional players. It's a huge vote of confidence.
So how does this actually push the price up? Well, it's pretty simple actually. Like we just said, when billions of dollars flow into these ETFs, the fund managers are forced to go buy real Bitcoin on the open market. This constant buying starts to dry up the available supply and, basic economics 101. When demand goes up and supply gets tight, it puts serious upward pressure on the price.
And it's really important to get this straight. This isn't the same as day traders speculating on price moves. These huge, steady ETF inflows, they often represent strategic, long-term decisions. We're talking about major players deciding to allocate a permanent piece of their massive portfolios to an asset. It's a whole different ballgame.
All right, now let's zoom out. We've talked about crypto, but let's see how this exact same idea applies to the entire stock market, where you could argue it's even more powerful. We're going from a single asset to trying to read the mood of the entire economy.
I mean, the scale here is just staggering. In a single month, one single S&P 500 ETF took in over $14 billion in new money. That is a tidal wave of capital saying, we believe in the broad U.S. stock market. It's a massive signal of confidence. This visual really says it all, doesn't it? You can think of these flows as a live scoreboard for the epic battle between market bulls, the optimists, and the bears, the pessimists. Inflows are basically the bulls casting their votes with billions of dollars, and outflows? That's the bears getting defensive.
So, if we boil it all down, what does it all mean? Well, when you see inflows consistently rising, it's usually a sign that investors are feeling brave, they're willing to take on more risk, and they're confident.
On the flip side, big outflows can be a warning flare. It might mean investors are getting scared, worried about the economy, or just cashing in their chips. Okay, so let's bring it all home. What's the big takeaway here? Why should you even care about any of this?
If you remember just one thing, let it be this. Talk is cheap, but where people put their money is real. Headlines can be designed to scare you or excite you. Speculation is just noise, but ETF inflows? That represents actual money being put to work, which makes it one of the most honest signals you can possibly follow.
But of course, it's not a magic 8-ball, right? You gotta remember, day-to-day data can be noisy, and sometimes the price impact isn't immediate. The real key here is to use this information for context, to understand the big picture, not to try and predict what's gonna happen next Tuesday. It's a guide, not a crystal ball.
So, I'll leave you with this idea. It's a small shift in how you think, but it's a really powerful one. Instead of getting obsessed with what the price did yesterday, start asking yourself a new question. Where is the money flowing today? Because if you can follow the capital, you get a much better sense where prices might be going tomorrow.